Hello, global family, and welcome to the Vuyo Show, your daily source of all things global business. I am your host, Vuyo. Let's get straight into our first story for the day. Now, BIC is warning that gold and stocks forming a double bubble. The Bank for International Settlements, often described as the central bank of central banks, has issued a warning that both gold and global equities are rising at an unusual, historically rare levels at the same time. This synchronized surge is raising concerns of potential overvaluation in financial markets. Gold prices have climbed sharply over the past few months as investors search for safe haven assets, while major stocks indices continue to push upward despite mixed economic signals. And according to the BIS, this parallel rise may indicate excess liquidity in the system and a growing investor risk appetite. This is an unusual situation because these two asset classes usually move in opposite directions. The BIS is also warning that this concurrent surge points to a significant market risk where a potential crash in one or both could have widespread financial consequences. If you're probably wondering what is a double bubble, this is, what we can refer to as the existence of speculative bubbles in two different, often unrelated asset markets at the same time. And this is how we kind of break it down in these two simple concepts. The first being the bubble, which is a financial term in rather used in financial terms as an economic cycle that's categorized by a rapid escalation in asset prices that is not justified by the asset's intrinsic or true value. And how it forms is that prices rise sharply due to speculative buying, hype, one would say, and the greater fool theory, which is the belief that someone will pay a higher price for this particular asset at a later stage. And the results eventually are then the buying frenzy stops, the investor confidence wanes, and a wave of selling begins, causing the bubble to burst and prices to dramatically fall, which then indicates or leads to a crash. The context then together combined of a double bubble is the specific, it is in this particular context at least a specific warning that, concerns are stemmed from the factor that gold and stocks typically act as as checks and balances and against each other. So stocks being equities traditionally viewed as risky asset classes that performs well during periods of economic optimism and growth, such as the current excitement around artificial intelligence, where so many people within the investor space are looking to kind of tap into that risky asset class. However, right now it is, under a lot of optimism as an industry in and of itself. However, when you compare that to gold, which is a traditional, one would call a safe haven asset, where investors put their money during times of economic or geopolitical uncertainty, where inflation fears or when the stock market is doing a bit poorly, that's where investors would then safe haven their assets or their money within golds and a lot more, traditional safe haven assets. Now, historically, why this is a big concern is that the correlation between the two has been close to zero or even at a negative. When one goes up, the other one tends to remain steady or falls. However, in this concern, what the BIS is raising is that both gold and stocks are hitting records high simultaneously at the same time, which is a phenomenon not seen in at least half a century. And this apparent contradiction suggests that a market is driven by an unusual combination of AI optimism and cautious hedging, or simply massive amounts of liquidity from government stimulus rather than sound economic fundamentals. The danger of what we are calling a double bubble is that if both markets correct or crash at the same time, investors may have nowhere to, shelter their money, leading to a potential and even more dire widespread of economic and financial crisis. That's something that we are trying by all means not to have and hope not to have. But if you're probably wondering why, is this a concern? It is something that if you're an investor, or rather within the financial sector, you probably have an understanding of why this is a big concern. I do think that we are currently in a AI bubble, which might be an, part of what this double bubble kind of signifies. There's a lot of optimism in the AI space and a lot of excitement around AI, and that's where everything is currently going. Now, about a month ago, when on one of my YouTube randevels, I found a video where the board of changemakers were having a conference about the geoeconomics. I believe it was in Abu Dhabi, and I heard one of the most leading voices in the safe haven asset, space, which is Dr. Patrice Motsepe, who is the founder of African Rainbow Minerals, which is, which is a company founded in 1997 that's, buys low producing gold mine shafts and makes them profitable by expanding into various metals, gold, platinum, iron, coal, etc. But in this particular video, which I'm going to show to you in a second, he get to explain why currently right now, because we fundamentally understand why AI, could be an optimism or optimistic type of asset class in this particular capacity. But he has to explain to us, when asked by the host of this particular roundtable, why is gold currently in this particular exact moment high? Why is the price of gold high? I believe about a month ago, it was $4,000 a pound, I believe, that he had kind of asked. So I'm gonna let you watch the video and, get to listen to what he says is the reason why gold is so expensive. And then I'll come back and we'll dissect this even further.
Why is gold more than doubling in price? And in the last year or so, gold is over $4,000 an ounce. Is it a good buy now, or is it now overvalued?
Well, let me start by thanking Yasser and Richard for doing an excellent job bringing the world together. Saudi is a reliable and a trustworthy partner, and thanks for the great work. We've got about 50,000 employees in our gold mines, and we've got investments in Australia and Papua New Guinea. Gold has always been a reliable source of wealth. We love the dollar, we love the euro, but during difficult times, the world, as has recently been reflected by the central banks, they fall back, and gold plays an important part. But as an entrepreneur, we have to diversify. So
now, after hearing that, the question that I think you and I have to ask ourselves is, what does this actually mean, right, for both business as well as global markets? Because we all fundamentally exist within these, within these spaces. And the first is that what we need to consider is that when both the safe assets as well as the risk assets, right, the gold as well as the stocks within these kind of higher risk, assets, when they're rising together, it often means that investors are confused, not really sure right now and uncertain about where the global economy is heading, which is a very uncomfortable spot to currently be in. And the pressure of AI, to be quite honest, is causing a lot of uncertainty to a lot of people. It's the rapidness of how fast it's going, not really sure of where and the vastness of what this industry is going to do is causing some sort of uncertainty, which leads to investors kind of being confused on where, or rather which asset class to fundamentally focus on in this moment. The second concern is that a double bubble is not about fear, but it is about timing. And businesses need to be cautious about high valuations, because correction cycles hit, when they hit those who are unprepared, which could potentially happen, that could be an issue, right? And this is a moment to watch global liquidity, central bank moves, and the psychology of investors very wisely. If you're a startup founder, you need to be kind of cautious and wary about, as I said earlier, the high valuation and overvaluing one's business, because a correction cycle is going to hit when you are much less prepared than you actually should be. And that's something that I would thoroughly advise that you be cautious about. Go ahead and check out the story in a lot more detail. It is by going into looking into a little bit further to what the BIS's recommendations are within this story. But we will be looking forward to unpacking it a little bit more as we move forward. But that's currently where the state of it looks like right now and what we need to be cautioned about. Story number 2 is that Nvidia has been named the best managed company of 2025. Who would have thought? The Wall Street Journal has named Nvidia the best managed company of 2025, highlighting its exceptional performance, strategic clarity, and operational discipline. Nvidia continues to dominate global AI hardware market, powering everything from cloud data centers to robotics, defense systems, and the next generation consumer technology. And this recognition comes as Nvidia navigates, supply chain challenges, global regulatory environments, and increasing competition from Intel, AMD, and several Asian semiconductor companies that are also producing similar products. Nvidia has been at an unprecedented speed of valuation growth as a company. The pace of this particular company's valuation has historically really been significant, it becoming the seventh US company to reach $1 trillion US dollars. I can't even say properly. 1 trillion valuation in June of 2023. It then reached 2 trillion in 2 trillion and 3 trillion. Oh, now it's a double at 3 trillion, far faster than any other company, including the big tech giants like Apple and Microsoft. And this year it hit a 4 trillion to a record-breaking 5 trillion market value in a matter of months, which is astonishingly fast, understandably, at the rate at which AI is currently running. It's becoming the world's most valuable company. Market capitalization has surpassed long-standing leaders and making it really the most valuable public company in the world as of late 2025. Its value is greater than the GDP of many countries and accounts for a significant portion of the entire S&P 500 index, underscoring its massive influence on the broader market in general. But what we can note from that is that Nvidia isn't just a company, it's an economic engine. The award then now signals something bigger, that we've entered into a global era where AI infrastructure matters more than ever, because we need the infrastructure in order to be able to, create and build upon what AI is and what it's going to be. And the companies that are going to win are those that invest early, that lead boldly and move faster than the market. If you're an entrepreneur, this Nvidia story is a reminder that innovation without execution is just an idea, but innovation with operational excellence becomes global leadership. I recently saw a video with the CEO of Nvidia, who got to talk about the passion that he has for the organization and kind of guides us and I think gives us context and framework into understanding how is a leader within a space of, a work environment. So I'm gonna let you watch this video, get a little bit of understanding of, who the CEO is and what his journey gives us context to seeing, because he has done an incredible job with Nvidia. And let's hear what he has to say.
And then along the way, there's always some evidence of success and that you're leading in the right direction. And sometimes you go a long time without evidence of success, and you might have to course correct a little. But the evidence comes, and if you feel like you're going in the right direction, we just keep on going. The question of why did we stay so committed for so long? The answer is actually the opposite. There was no reason to not be committed because we believed it. And I've believed in Nvidia for 30 plus years, and I'm still here working every single day. And there's no fundamental reason for me to change my belief system. And I fundamentally believe that the work we're doing in revolutionizing computing is as true today, even more true today than it was before. And so we'll stick with it, until otherwise.
Now, back to more financial news for today. The global markets watch as Fed decision quite closely. Now, across global markets, investors are holding their breath ahead of an upcoming Federal Reserve decision that could determine the interest rate direction for early 2026. Stock futures showed mid-gains today, but volatility remains evaluated as analysts expect the Fed to signal whether the rate cuts are likely to happen next year. Higher interest rates over the past 2 years have slowed borrowing, had pressured startups, and has really reshaped investment flows. A shift in policy could stimulate global economic activity and strengthen emerging markets. But what this particularly means is that investors and traders and businesses and governments around the world are paying extreme intense attention to what the US Federal Reserve's, also known as the Fed, monetary policy decisions, because those decisions have a massive impact, not just in the US economy, but just around the globe, in the entirety of the global economic ecosystem. From stock prices to interest rates to currency exchange rate and just holistically economic growth. So this decision has a very, very big role to play in what we're going to be seeing in the next year, 2026, particularly within the first early stages of the year. Now, the current Fed decision is being made during a two-day meeting hosted today, December 9th, as well as tomorrow, December 10th, of 2025. The official statement, policy statement, and interest rate announcement will be released at 2 p.m. on Wednesday, 2 p.m. Eastern time, that is, on Wednesday, December 10th, followed by a press conference with the Fed Chair Jerome Powell at 2:30 p.m. So we'll be closely looking out for that story and letting you guys informed on what the decision around the Fed is going to be and why we should be watching quite closely to what happens in that decision, because it is going to affect the global markets quite effectively. Why this matters for global markets is that the US dollar is the world's primary reserve currency, and US financial markets are the largest and most influential globally. The Fed's actions, particularly concerning the federal funds rate, have far-reaching consequences. Interest rates and borrowing costs, the Fed's rate decision sets a benchmark for borrowing costs, not only within the US, as I said, across the world, and changes that affects rates on everything from mortgages to credit cards to corporate loans to government bonds. Lowering rates makes borrowing cheaper, which can stimulate economic activity, but while raising them is intended to cool down an overheating economy and fight inflation. When it comes to market volatility, the market reaction can be significant and can swift. For instance, if the Fed does not meet the market expectation for a rate cut, currently priced at over 80% likelihood, major stock indices could drop sharply. Currency values, the decision impacts the strength of the US dollar. A stronger dollar can make US exports more expensive, but foreign goods, on the other hand, cheaper, affecting trade balances globally. It also does affect, investment flows, and the rate decision influences whether investors decide where to put their money, right? Higher US rates can attract capital away from other countries, putting pressure on other countries' currencies and stock markets, which could fundamentally kind of have a shift in the global ecosystem generally. Because markets are currently divided on the next steps right now due to conflicting economic signals, right? A cooling labor market versus a persistent inflation. Traders are also looking closely, watching the Fed's dot plot, which is the economic projections for future rates. And we'll find out from the chair Powell's press conference for clues about the future path for monetary policy into 2026. If one has to kind of really think about this, the Fed doesn't just influence America. The Fed's decision, it influences the entire world. When the Fed moves, currencies shift, global debt pricing changes, and the business expansion becomes either more expensive or more accessible. If the Fed signals rate cuts, we will see a different energy in 2026, more investment, more risk-taking, more cross-border activity, more going global. But if they hold rates high, businesses must prepare for a more conservative year. What matters now is the agility, right? What makes that possible is companies that are adapting quickly. They are the ones that are going to outperform in 2026, being ready, being able to kind of adjust according to what the market is predicting and is moving towards. And as an entrepreneur, as an investor, this is definitely a story to be on the lookout for and be mindful of. We will be coming back on when this decision does come out to unpack it a little bit more further, but be on the lookout for that too. Now, our last story for today, the Gulf sovereign wealth funds expand global influence. Now, in the first story, I showed you guys a video where the Gulf had an experience of global leaders coming together within the financial, innovation, and technology sectors coming together to host these types of roundtables that you just saw in the first story. And we are going to continuously see a rise in that happening because new data shows that the Gulf sovereign wealth funds, especially from Abu Dhabi, are increasing their influence across global finance. These funds now manage trillions. We are back to the trillions of assets and are investing heavily in climate innovation, in AI, in energy transitions, in sports and tourism, and emerging market development. And this surge in Gulf-backed capital is reshaping global investment flows from Africa to Southeast Asia to Europe and the US. And their strategy long-term, patient capital, is giving them a growing voice in global corporate governance. It really is starting to look like a lot of investment potential from that particular region in the world is going to have a lot of influence looking into the future. Look at Dubai, Abu Dhabi, all of these countries that are currently within the economic zeitgeist as being the ones to be on the lookout for. And the Gulf sovereign wealth funds expand global influence. And what that really means is that investment funds owned by governments in the Middle East, Persian Gulf region are rapidly increasing the size and scope of their investment in companies and assets, not just within their region, but around the world, giving them more economic power globally. And what the Gulf sovereign wealth funds are, what we'd call the SWFs, are state-owned investment funds. And the Gulf in this context now refers to the countries that are rich in oil and natural gas, normally located within the Persian Gulf, primarily, as I said earlier, like your Arab UAE, which is one would call the United Arab Emirates, Saudi Arabia, Qatar, Kuwait. These are countries that accumulate vast amounts of wealth from their natural resources and establish these funds to invest that money internationally and save it for future generations, where that looks like diversifying the economies away from sole reliance on fossil fuels. An example of this would be the Abu Dhabi Investment Authority, also the Saudi Arabia's Public Investment Fund, the Qatar Investment Authority. These are all, the bodies that are part of this government, the part of the government investment funds that are state-owned in those particular countries. And these funds are, they manage trillions of dollars in assets. Impact on global entrepreneurs, investors, and global leaders has also something to kind of note, as the expansion of these funds has a significant implications of what global business and its landscape potentially looks like. For entrepreneurs, this gives access to capital, right? The Gulf's SWFs are massive resources and sources of funding, often looking for stakes in promising private tech companies, startups, and infrastructure projects. And this provides entrepreneurs with a potential new avenue for significant long-term capital to scale their businesses. Strategic partnerships as well, and investment from a major SWF often comes with the political connections and access to new markets within the Middle East and further beyond, which could be strategically valuable for an entrepreneur who's looking to get within those markets too. Now, for investors, on the other hand, what the major market players, or the ones that are the funders and the investors within the market, the funds are now some of the biggest players within global finance, and their investment decisions can move markets. Understanding their strategies as an investor is crucial for other large institutional investors. Co-investment opportunities are also possible within this nature, where many large private equity and venture capital firms often partner with these SWFs for large deals, for creating opportunities for co-investment and shared risk in major global projects. Now, for business leaders just globally, what this also could potentially be is that the surge could mean new owners and board members, right? In the past few years, these funds have taken large stakes in major global corporations across industries like technology, finance, real estate, sports, right? And business leaders may find that their companies have new, powerful stake-backed owners and board members with long-term investment horizons, unlike typical public market investors who demand quarterly returns. It also means that geopolitical and economic influence, because the flow of capital is linked to diplomatic influence, right? As these funds invest more globally, the economic influence of their home nations grow, potentially impacting international business regulations and political relationships. And this also kind of requires focus on long-term growth, because unlike typical investment funds, the SWFs are not driven by immediate quarterly returns. They often invest in large transformative projects like new cities, green energy initiatives, deep tech, and which business leaders in these sectors can leverage for long-term growth and opportunities. Now, what this means here is that the center for global capital is shifting. The traditional West is not really much longer the only major source of funding. The Gulf is becoming a powerhouse with a strategic mandate, which is to diversify beyond oil and build the future economy. For businesses, understanding the Gulf investment trends is going to be critical. So whether you're in tech, in energy, in sports, in infrastructure, or tourism, the Gulf is not just a market, it's a global player shaping the next decade of business. Now, I hope that you've learned so much from this episode, because we are wrapping up today's edition, but the message is quite clear that we are living in a moment of global transition. Markets are shifting, leadership is evolving, capital is moving, and emerging markets and economies are rising. From the BIS warning to Nvidia's leadership to the Gulf's glowing and growing global role, and so much more, the world's economy is becoming and being rewritten in real time. I hope that you have, again, learned a thing or two in this episode. I'd like to know your thoughts in the comments. Let us know what you think is going to be some of the predictions from that particular conversation with the BIS happening this week. And we'll be back to bring that to you, to give you an update on that particular story. But thank you for watching The Vuyo Show. It is your host, Vuyo. And most importantly, I would like to invite you to please stay informed, stay curious, and always stay global. I'll see you on the next episode.